On December 10, 2024, the financial world was mesmerized by a single number, $62. That was the price of an ounce of silver, a peak we hadn't seen in over a decade, but while Wall Street was popping champagne over the ticker tape, they missed the execution order signed in Beijing just 41 days prior. On October 30th, 2025, the Ministry of Commerce in China quietly released document number 68. It wasn't a press release, it was a bureaucratic weapon. Buried in the fine print of that document is a mandate that effectively decapitates the global silver supply chain starting January 2026. Here is the mechanism they are using. If a Chinese company wants to move silver across the border next year, they must prove they mine at least 80 tons of the metal annually. That sounds like a standard regulatory hurdle until you look at the industry data. The vast majority of China's silver exporters, companies that have supplied the West for 30 years, only produce between 10 and 30 tons. With the stroke of a pen, Beijing didn't just regulate these companies, it erased them. We are talking about a forced extinction of 90% of the export market last year. China sent $37 billion worth of silver abroad, accounting for 13% of the entire planet's supply. You might shrug at 13%, but that margin is the only thing keeping the lights on in London and New York. The Western markets are running on fumes, completely dependent on Chinese flows to refill their emptying vaults. Just look at October 2024 in a single month. China flooded London with a record-breaking 660 tons of silver. They didn't do it for profit, they did it to stop a collapse. The London Metal Exchange was bleeding out, warehouses were empty, and the premiums to get your hands on actual bars had rocketed 20% over the spot price. China opened its strategic reserves and bailed out the short sellers to prevent a total systemic failure. But that rescue mission was a Trojan horse. China depleted its own buffer to save the West, and now they are welding the exit doors shut for 2026 and 2027. The message is brutal in its simplicity. We saved you once, but the next crisis is yours to face alone. Consider the timeline, because this is where the secret history of currencies reveals the coordination behind the chaos. On November 1st, 2025, the United States formally designated silver as a critical mineral, opening the door for national security tariffs. 48 hours later, Shanghai's inventory levels dropped to a 10-year low. Then boom, silver tears past $62. Do not mistake this for a series of random events. The odds of an export ban, a U.S. critical mineral designation, a localized inventory collapse, and a 23% price explosion happening within a 40-day window by accident are zero. This is a resource squeeze masquerading as administrative policy. China is playing four-dimensional chess while the West is still reading the instruction manual for checkers. This isn't about spite, it's about survival. China isn't hoarding silver to hurt us, they are hoarding it because their future depends on it. In 2024 alone, China expanded its solar energy capacity by a staggering 45%. Solar panels are voracious consumers of silver, eating up 232 million ounces a year. That is nearly 1/5 of everything mined on Earth. And here is the physics problem that no amount of money can solve. You cannot build a solar panel without silver. It is the most conductive element on the periodic table. You can't swap in copper, it corrodes you. Can't use aluminum, it's too inefficient, there is no substitute. Every panel rolling off a Chinese assembly line requires silver paste. And China manufactures more panels than the rest of the nations on Earth combined. The math is unforgiving. Domestic Chinese demand is outpacing global mining output. Every ounce they export is an ounce they can't use for their own infrastructure, so they made a strategic decision. Keep the metal, secure the energy revolution, and let the rest of the world fight over the scraps. The method they chose is insidious. The new state trading management system requires exporters to have a credit line of 200 million yuan, roughly 28 million US dollars, plus a string of ISO certifications and a history of continuous exports since 2022. Translated, this means unless you are a state-owned titan like the Zhejiang Mining Group, you are finished. The small and medium-sized players that actually keep the market fluid are being liquidated. If this sounds familiar, it's because we have studied this playbook before. On The Secret History of Currencies in 2010, China held a monopoly on rare earth elements. When a territorial dispute with Japan flared up, Beijing simply turned off the tap. Japanese tech giants, desperate for dysprosium and terbium, watched their production lines grind to a halt. Billions in value evaporated because the raw materials just stopped showing. Up, that was a warning shot. This is the main event. Silver is far more vital than rare earths ever, where it is the lifeblood of the green economy, 5G networks, electric vehicles, and the AI data centers springing up across the globe. China has effectively locked $37 billion of this critical blood supply inside its own borders. Meanwhile, the financial news networks are still drawing lines on charts talking about technical breakouts. They are blind to the geopolitical ambush unfolding in plain sight. This isn't a market trend, it is pre-positioning for a resource war that begins in exactly 36 days. That is the countdown. You have 1 month before the export ban goes live. 1 month before 13% of the world's silver vanishes from the open market. 1 month before companies like Tesla and Samsung realize the materials they need to build the future simply aren't there. The fundamental data is screaming a warning that Wall Street ignores. We have seen 4 consecutive years where the world consumed more silver than it mined. From 2021 through 2024, the cumulative deficit has reached 678 million ounces. Imagine 10 months of global mining output just disappearing. That is the hole we are in. Where did it go? Into the solar fields, into the smartphones of Taiwan and Korea, into the EVs of Detroit, and into the cooling systems of AI servers. These are not optional luxury goods. They are the skeletal structure of the modern world. And they are all fighting for a shrinking pie. In 2024, the gap between what we needed and what we dug out of the ground was 385 million ounces. To visualize that, imagine the entire country of Mexico, the world's silver king, stopped mining for a year. That is the scale of the shortfall. You might ask, at $62 an ounce, why don't miners just dig faster? This is the geology trap. 70% of the world's silver comes out of the ground by accident. It is a byproduct of copper, lead, and zinc mines. A copper miner in Chile cares about the price of copper. Silver is just the tip money. Even if silver goes to $100, that miner isn't going to ramp up production if copper prices are flat. The supply is inelastic. It doesn't care about the price tag. Furthermore, building a new mine takes nearly a decade of permits and construction. The capital flowing into mining right now is chasing lithium and copper, not silver. We are trapped in a supply box with the walls closing in. We saw a preview of this disaster in London last October, when the physical metal dried up. Paper contracts became worthless promises. Traders desperate for physical delivery were forced to pay premiums of 20% just to get metal in hand. That is the difference between a theoretical price and a reality price, and that was before the ban. China stepped in then to stop the bleeding, but in October 2025 they signaled the end of their generosity. The London bailout was a one-time offer. Now look at the demand curve. In 2015, the solar industry used 60 million ounces. Today, it uses nearly 4 times that amount. The International Energy Agency predicts we will add 3,500 gigawatts of solar by 2028. This isn't just corporate PR about going green. It is massive industrial consumption happening in real time. Research published in Science Direct peer-reviewed hard science projects that by 2030, demand will outstrip supply so severely that miners will only be able to fulfill about 60% of orders. We aren't looking at a price hike. We are looking at a mathematical impossibility. The smoking gun is the Ministry of Commerce announcement number 68. It requires an 80-ton production minimum. It demands ISO 14000 certification. It sets financial barriers that only state-controlled behemoths can clear. This is a deliberate purging of the private export market to centralize control under the Chinese state when they cut off rare earths to Japan. It took 5 years and billions of dollars for supply chains to recover. Now imagine that disruption hitting 4 major industries, solar, AI, and telecom simultaneously. We are staring down the barrel of a perfect storm, a 4-year structural deficit, inelastic mine supply, vanishing inventories, and now the weaponization of exports by the dominant global player. This is not speculation. It is a documented sequence of events leading to a singular conclusion. Western markets are about to lose access to a massive chunk of supply right as demand goes parabolic. Here is the precise timeline of the crash. January 1st, 2026. The ban activates. The small exporters go dark. Then the spring construction rush begins. Solar manufacturers in the US and Europe will place their orders for silver paste only to receive force majeure notices instead of shipments. By March 2026, the futures contracts on the COMEX expire. Long traders will stand for delivery expecting metal. but with Chinese flows cut and warehouses already down 10% from their peaks. The metal won't be there. This is the scenario that breaks the market mechanism itself. You have 36 days. Let's look at the valuations historically. It takes roughly 67 ounces of silver to buy 1 ounce of gold. Right now, with gold at $4,200 and silver at $62, we are sitting exactly at that average. But the geology tells a different story. For every ounce of gold we mine, we only find 7 ounces of silver. If the price reflected reality, silver should be multiples higher. If we account for the Chinese supply shock removing 135 million ounces from a market, already in a 200 million ounce deficit, we enter uncharted territory. We are looking at a 29% supply gap. The Hunt brothers managed to break the market in 1980 with a 15% deficit. We are facing double that pressure. Conservative estimates put silver at $65 by the second quarter of 2026. But if panic sets in, if companies like Intel and First Solar start hoarding inventory to keep their factories running, we are looking at $8,595 or even triple digits. At that point, the price becomes irrelevant. Availability is the only metric that matters, and there is one final trap: tariffs. If the U.S. president uses the Section 232 authority to slap a 50% tariff on imported silver for national security, and China simultaneously bans exports, the metal becomes stranded. Mexican and Peruvian silver won't flow north if the tax is too high, and Chinese silver won't flow out at all. This creates a fracture where physical premiums could hit 40%. A paper contract might say $70, but buying a physical bar will cost you $100. Who dies first in this scenario? The just-in-time manufacturers, solar giants, chip fabricators, and EV makers typically hold only 1 or 2 months of inventory. If the tap runs dry in January, they are in crisis mode. By February, they will have to choose: pay any price to survive or shut down the assembly lines. This is the thesis of the secret history of currencies. We don't look at the charts, we look at the structural flaws underneath them. The trap is set, the timeline is fixed: 36 days to the ban, 90 days to peak demand, 120 days to contract expiry. China saved the market in 2024 by opening the vault. In 2026, they are locking it. When the world wakes up to a supply shock that makes the 1980s look like a rehearsal, the time for positioning will be over. The transfer of wealth will have already happened. The only question remaining is whether you acted while the window was still open.